Tonight, Senator Ted Kaufman, Democrat from Delaware, called for a review of high-speed trading following today's sharp market swing. It's a strategy that's helping some investors gain an edge, but is it creating excessive volatility? Joining me now, Irene Aldridge, managing partner at Able Alpha Trading, CNBC's Rick Santelli, and Joe Saluzzi, co-head of equity trading at Themis Trading. He joins us on the phone. Let me throw up a jump ball here. I mean, can somebody actually, for our viewers' purposes, explain the difference between high-frequency trading, black box strategies, so to speak, that employ algorithms usually employed by quantitative hedge funds, and program trading? Or should we all lump them in under the same thing? Who wants that one?
Sure, I'll take it.
Okay.
Well, first of all, I'd like to say before I begin, it's a great pleasure to be here. And number two, I feel terrible for all the people who lost money today, particularly people with 401k or pension fund savings. But besides that, it's too easy to make high-frequency trading a scapegoat here. And to your question, the high-frequency trading is a subset of algorithmic trading. Most of it is done using black boxes, meaning if you're standing next to a high-frequency trader, meaning a computer machine, you don't exactly know what's going on inside. So from your perspective, it's a black box. It's also, most of it is done via computer programs, which are program trading. That's why they're called program trading. So it's sort of more or less the same thing. Algorithmic trading is a much wider sort of set of strategies. They also involve execution strategies. NASDAQ has been using algorithmic trading for over 20 years now in processing orders and matching orders. So it's a lot wider field. High-frequency trading typically refers to intraday trading in the black box setting.
Right. Well, Irene, given that explanation, thank you for it, and your knowledge, what is your sense of what actually happened today?
Sure. Well, there are three things that we know that could have happened. So first, it was the fat finger theory, that somebody has keyed in the wrong digits. So instead of 1 million, it was 1 billion somewhere on the trading floor, and the whole market
that wouldn't
just
seem to explain the entire thing, though. I mean, there were some moves in some of these individual stocks that were very, very odd and wouldn't explain, perhaps, somebody screwing up in terms of how many futures they wanted to sell.
Fair enough. So the next best thing is perhaps there was a glitch, okay? So computers are only as good as the people who program them. So perhaps, and I think many traders, computer traders, have made this mistake, is you forget to what's called a close the loop. So your trading program keeps trading and trading and trading when it's not necessary. And and there are processes for development of these systems that I describe in my book, High Frequency
Wait a
Trading.
minute. We need to stop here a minute.
Go ahead,
Rick. We can make it even more simple. Here's the issue. Computers shouldn't be blamed for the whole thing. They should be blamed for the path. They should be blamed for the path, how it played out. Ultimately, I believe stocks will retest those lows. But here's the deal. When trading is normal, there's an increment of bid-offer spread. It's usually you can't drive a pin through it, and the computers understand that. But what happens when S&P futures get crazy? All of a sudden, they're bidding in full-handle bid-offer spreads. To the computer, that's still the narrowest increment at that point. So the computers are all daisy-chained together, and when the bid-offer spread widens out this way, whatever increment it takes to get an order done, the computer will find, except for you're looking at 10 times wider bid-offer spreads, and the path becomes much bigger in terms of distance traveled. And like uptick rules, what we really need to do is not condemn the computer, but condemn people for daisy-chaining them all together without the types of circuit breakers we've seen implemented in futures markets for years. When things get dicey and the bid-offer spread goes nuts, they should be shutting down some of these systems that will continually try to fill orders no matter how wide or how thin markets are. That needs to be addressed because technology has moved much faster than the ability that in the old days where humans would take a step back.
And it's
you can't go back to humans anymore.
It's been faster than the regulators can keep up with. You make a great point on the circuit breakers, Rick. So if we had, let me ask you about the uptick rule, something I asked Matt Nesto earlier. If the uptick rule were in place today, would we have seen the damage that we saw today?
No, and I think if the uptick rule was modified to include the computer world we live in, we would have had a much different flight path.
So I wonder how culpable the regulators are. I mean, I do not understand how Procter & Gamble could have seen the trades that it saw today.
I agree, and I can't believe regulators don't know that when the New York Stock Exchange stops trading, that the next weak link isn't taken care of adequately.
Joe Saluzzi, I mean, Have you ever seen a day like today, and who do you think is to blame?
Well, there's no doubt who's to blame are these quote-unquote liquidity providers who claim to be these high-frequency traders. What happened here is a breakdown in the equity market structure, okay? This is what we have. We have a market structure in which now depends on these high-frequency traders for liquidity. And when times are fine and there's really no volatility, they claim to provide this liquidity. But what happened today was they ran for the hills once volatility spiked up. And we don't know what the reason was, whether or not it was a fat finger, a quant blow up, a carry trade blow. But the bottom line result was when you needed liquidity the most, they were nowhere to be found. The bids faded. The vacuum existed. All the stops kicked in. And all these poor retail people that Irene is so concerned about, they lost a ton of money today because of their stop-loss market orders got kicked down. And then 60%. NASDAQ, give me a break. Where did you come up with that number?
Well, I don't understand how, the New York Stock Exchange halts trading in Procter & Gamble for 90 seconds. And in that 90-second period, Procter & Gamble goes from trading on the New York Stock Exchange at $61 a share to $39.
New York tried to help by slowing things down because they went to a slow market so that some of these high-frequency traders couldn't hit their bids while they were exiting for the hills quickly. It didn't work. It was too late. Because
Irene, aren't there supposed to be some...
We've been warning about this at Themis Trading for over a year now. We knew this would happen. And by the way, this is going to happen again until they address the market structure.
Well, Irene, go ahead and answer that. Is it going to happen again? Aren't there fail-safes? Aren't there stops in these systems, flags that go up?
There's nothing in the financial regulatory reform about this.
Right. Well, first of all, I need to invite Joe for lunch. I meant for a really long time. But second is, besides that, I think you have to also give credit to how to high-frequency trading specifically, about how quickly the market has recovered. A lot of people are talking about how quickly the market has gone down, and it usually happens this way. Market goes down very quickly when there is a huge selling pressure. But markets used to go back up really, really slowly. It used to take days or months for the market to recover. And this is something I think we've seen unprecedented today, where the market recovered almost instantaneously. And I think this is where the algorithmic trading definitely deserves credit.
Right, but somebody sold these stocks. Somebody sold these stocks down a lot. I mean, are there going to be losses here or not?
Huge losses.
Yeah,
There's going to be tremendous losses on the retail side.
On the retail side or on some of these quant black boxes, Joe, that actually got out of these things because their algorithms were telling them to?
Well, I spoke with a lot of...
blew up. They did it again. I mean, read Scott Patterson's book, The Quants, if you want a story about the history of them. But we've got a few suggestions, if I can, as to how to fix this in the future.
And it's going to be trading with your firm, I assume. Would that solve it all?
No, we think that you need a large order tag to track the high-frequency traders because of the damage that they can do. We think there needs to be an order cancellation fee attached because 95% of their orders are canceled. And to be honest, we're going to be detailing in a new paper coming out soon how the exchanges are giving away information that institutions think is private and hidden, and they're selling it to these high-frequency traders for a fee.
Yeah, well, Joe, I think you're absolutely right. I think everybody agrees now, by and large, that there has to be some way to tag and identify people who trade, because right now it's very easy to distribute one's trades and make them completely disappear in the market and leave zero trace. So but nobody's arguing, I think, anymore that there has to be. I think everybody agrees that there has to be a way to do that. But at the same time, if you brought an interesting point, Joe, and it's about stop losses. Is that stop losses cause the downfall almost of these stock prices?
Yep.
And if people who use algorithms, sophisticated algorithms, they have rolling stop losses.
We got to run.
It's not the same.
Very, very important and insightful comments, everybody. Thank you very much. We wanted to give you a quick check on the markets in Asia right now to give you a sense of